So in today's video, I'm going to discuss about position sizing and risk management and why this remains a cornerstone in order to become successful in stock markets. Now, how do you define what position size is? Now, in my opinion, position size is that amount of stocks you buy in the market that gives you a balance between your own psychological comfort and with respect to the risk that you can take as per your account. So in other words, an ideal position size would be something that offers a great balance between your own psychological profile and your risk profile.
Click on the subscribe button and bell icon to get instantly notified when a new video is uploaded. Thank you for subscribing.
So one of the reasons why you have to understand the importance of position sizing is because of the kind of moves that happen in the market. Now, in case you are short at this position and you have taken positions that are way above the risk profile of your account and the next day market gaps up, you can lose 10, 20, 30% of your account in one single session. Now, same applies in this case. In case you are taking a breakout here and you go long here, if you do not calculate the ideal position size as per your account, during such market openings, your entire account can be wiped off. And this especially holds true if you're taking leverage in the market. Now, which is why I am going to show you how position sizing can help you avoid such situations and keep you on the right track in order to grow your account as years progress. Now, not many traders realize this, but in case you're a long-term trader, you need to have a different position sizing model. And in case you're a short-term trader, your position sizing model can be completely different. Now, what I'm going to show you in this video is pretty basic stuff, but let me tell you, as retail traders, these basic strategies work exceptionally well. Now, once you become a full-time trader and you gain more experience in the market, you can then use some advanced position sizing techniques that will help you develop further. So I categorize position sizing into two strategies. Number one for long-term trading and number two for short-term trading. So let me now take up long-term trading first, that is position sizing strategy with respect to long-term trading. So the first position sizing strategy that we will discuss is the equal value position sizing method. Now under this method, you allocate the same amount of capital to all stocks that come up in your radar. So let us assume that you have an account size of 100,000 and for the entire year, you would only be trading in 20 stocks. So let's assume that one of these 20 stocks gives you a buy signal or a short signal. In this particular case, you would equally divide your 100,000 capital over 20 stocks, that is the number of stocks you want to trade, and then allocate that amount of money in that particular stock that gives you a buy signal or a short signal. So when account size is 100,000 and total number of stocks you want to hold in your portfolio is 20, then you simply divide 100,000 by 20 and you get allocation value of 5,000. Now this means that each stock that gives you a buy signal or a short signal, you would be allocating only 5,000 rupees or let's say dollars, depending on where you trade, that amount in the stock. I hope this aspect is clear. So as each trade qualifies for entry, the maximum allocation under this method that you do is 5,000 per trade. So this is the main reason why this is called equal value position sizing strategy. So one of the things that I like about this strategy is that it's fairly easy to implement and you can actually include this in your trading plan from the next session itself. Now the reason I say so this is more suitable for passive investors and traders is because not everyone is a full-time trader and there are market participants who are doing a full-time job somewhere else. And for those individuals who are indulging in long-term trading or let's say investing, this way of position sizing does work well. So let me just explain how you would be exiting a trade based on this method. So let us assume you have taken entry at this level, that is 30,800. So the way you can exit this position if it is not working in your favor is by keeping a fixed percentage stop loss approach. So under this method, you can have a fixed percentage stop loss approach wherein after you have taken an entry, in case stock falls above 15%, you can then go ahead and exit that position. So while you are allocating money in the stock based on fixed value, you can exit the stock based on a fixed percentage stop loss approach. I hope this aspect is clear. Now the second position sizing approach that we will discuss is the equal risk approach. Now under this particular approach, one of the first steps that you have to determine is to identify initial stop loss. And then based on your account size, you need to calculate how much money you want to risk per trade. Now this is done in percentage terms. So in case you're a beginner in the market, what I would suggest is that don't risk more than 0.5% or 1% of your entire account size. Now what I mean by this is that in this particular example, I have assumed that I am taking 2% risk per trade. So what I will do in order to calculate my risk amount, I would calculate 2% of 100,000 in order to determine the risk amount per trade. Now once I have determined my risk amount per trade, I would then calculate my position sizing based on the formula given here. So I would take risk per trade figure and divide it by the difference between entry and stop loss. So this is the main reason why you need to be aware of your entry and stop loss level, and then you need to take into account how much risk you have to take in percentage term depending on your overall account size. I hope this aspect is clear. So let me just explain this with this particular example. So in this particular chart, the entry is visible at 780. So this is simply a breakout trade that you're taking. Stop loss is set at 760. So the difference between entry and stop loss is 20. That is 780 minus 760. So based on the calculation that we saw in the previous slide, risk amount was determined as 2000, that is 2% of overall account size. So your position size therefore would be 2000, that is risk per trade, divided by 20, that is difference of 780 and 760. So your net position size comes out to be 100. Now typically during market hours, it becomes difficult to calculate positions as the market is trading, because your entire focus is on identifying the correct entry price, stop loss, and various other factors. So what I've done is I have developed a simple position sizing sheet, and based on which position sizing technique you prefer, you can simply enter the values and get the ideal position size as per your account during market hours. Now developing such sheets is actually extremely helpful for a trader, because during the market hours, his entire focus can then remain on trading. So let me first explain on this sheet the first position sizing technique that we saw, that was the fixed value position sizing. So under this technique, you simply have to enter your entire account size number here. You also need to enter how many open positions you want to carry in the portfolio. That is whether it is 5 position, 10 positions or 15 position. And based on the number of stocks that you want to carry here, this amount automatically gets adjusted. So let us assume you want to carry 10 positions. You simply have to go and adjust this value as 10. So automatically you will see your position size number changes. So why this is happening? Because your position sizing number depends on the number of stocks you want to hold in your portfolio. So if you just want to hold 3 stocks, your position size would automatically increase. I hope this aspect is clear. So the second position sizing method that we saw was equal risk based position sizing. So under this method, you simply have to enter your account size, your stock entry price, your stop loss price, and then you need to determine how much money you want to risk on each trade. Now, if you're a beginner, prefer this value to be 1%. Now I have set this value to 2%. You can simply change it here to 1% and automatically the position sizing would change. In this particular method, the difference between entry price and stop loss is important because it directly determines how much position you should be taking. So there is also one more position sizing method, that is volatility based. In this particular method, you should know your account size, you should know the volatility of stock. So the 18 value that you see here is the ATR 14 value on a daily time frame chart. Now this is a very standard indicator value and this is readily available in all softwares. Then you need to know your entry price. So in all these examples, I have taken the same entry price, that is 190 here, 190 here, and again 190 rupees here. You also need to know how much risk you will be taking per trade. So I'll just put this figure back again to 1% because that is what I advise all beginners to start with. So finally, in this particular position sizing technique, your position size is finally calculated as risk that you are willing to take per trade divided by 2 times of ATR value. So in this case, the risk amount is 1000. So 1000 will be divided by 18 into 2, that is 36. So which is why you get this 28 number. So in the equal risk based position sizing method, as you increase your risk, your position size will change. So if I make this 3%, your position size automatically changes from 100 to 300. In the fixed value position sizing method, as I decrease the number of stocks I want to hold in my portfolio, my position size number would increase. So if I decrease the number from 20 to 5, the position size value automatically increases. In the volatility based position sizing method, as volatility of stock reduces, position size goes up. Now this is a good method because you want to be holding less positions when volatility is high. So if I reduce the volatility to 5, the position size number would automatically go up. So look at this point. Now, if you're a beginner in the market, I would first suggest to begin with fixed value position sizing if you are a long-term trader, and equal risk-based position sizing if you're a short-term trader. Now, as you graduate to the next level in trading, you can then replace this fixed value position sizing with even volatility based position sizing. So at the end, you have to figure out which combination works best for you. Now this Excel sheet is readily available with me. In case any one of you wants it, just let me know in the comment section below. So the previous Excel sheet was already emailed to all of you who had written down in the comment section. And in case you haven't received that Excel sheet, then do let me know again. I will upload it in the community section and will leave the link for the same. Now the whole idea of using a position sizing strategy is to make sure that no trade creates such a drawdown in your account that it gets difficult to recover from. Now this is one of the key aspects that most beginners do not understand when they are participating in the stock market. Now apart from identifying the right position size, you also have to determine your risk of ruin, and you have to take notes of your trades in terms of R multiple. Now I have done 2 videos on this subject, and the link to both these videos would come up towards top right hand of your screen. Now if you're a beginner in the market, you should be watching these videos because these will help you manage your overall risk better.